Morning, ladies and gentlemen. I'm Alex Pollock of the R Street Institute, and it's a real pleasure for Desmond Lachman of AEI and me to welcome you to our discussion this morning of how should the Federal Reserve respond to the escalating emerging market risks. Of course, we saw one response yesterday, namely doing nothing with the Fed's still amazingly low short-term interest rates. Our title question clearly has two parts. First, how threatening are the economic and financial troubles and risks in many emerging markets, and how are they likely to play out? Second, how responsible is the Fed's unorthodox monetary policy for these problems, and what are the implications, economic and political, for the Fed going forward? As to the first part, as always, there are, of course, different opinions and forecasts among experts. Desmond has written of what he called the global economic crisis brewing in 2016. The IMF has described signs of distress in large emerging markets, higher risks of a derailed recovery, and a global economy which is highly vulnerable to adverse shocks. Other recent forecasts include financial crises in industries and countries around the world in 2016, and not only a global recession, but a general asset deflation. On the other hand, we've had a financial market rally recently, and our honored panelist, Olivier Blanchard, and his colleagues have maintained that these negative views express what they called exaggerated pessimism, and that greater confidence in the world economy's resilience is justified, and that normal muddling through is more likely. We hope so. As to the second part of the title question, there's no doubt that the Fed promoted asset price inflation around the world, and that this in return promotes greater leverage against the inflated asset prices. Emerging market central bankers have complained about how the Fed causes problems for them and their countries and financial systems. How culpable is the Fed for emerging market economic and financial difficulties? And as the issuer of the world's dominant currency, what responsibility does the Fed have, if any, for the effects of its actions on the rest of the world? Turning to the U.S., 7 years after the end of the last real estate crisis, we now have what one commentator called fears over a U.S. commercial property lending surge, and we do have average commercial real estate prices that are well over their top of the last bubble. How much of that is due to the Fed? Needless to say, leveraged, inflated commercial real estate is a perennial culprit in financial crises. The last issue I'll mention is how much confidence does the Fed deserve? We've had a number of journalistic writings recently saying how bad it is that people don't seem to have confidence in the Fed or other central banks, and the Peterson Institute has worried about what they called widespread distrust of the credibility of central banks. Personally, I think a realistic lack of confidence in the Fed and all central banks is very healthy and very much to be encouraged. Well, I think we can't fail to have a lively and informative discussion this morning. Each of our distinguished panelists will make opening comments of about 14 to 16 minutes. I'm going to introduce them in the order in which they will speak. First will be Olivier Blanchard, who is the C. Fred Bergston Senior Fellow at the Peterson Institute for International Economics and the Robert M. Solow Professor of Economics Emeritus at MIT. Olivier previously chaired the Economics Department at MIT and was director of the Research Department of the International Monetary Fund. He's worked on the role of monetary policy, the nature of speculative bubbles. These two topics are linked, of course. The nature of labor markets, transition in former communist countries, and global financial crises, and he's the author of 2 textbooks in macroeconomics. Next will be Larry Meyer, the Chief Research Officer and co-founder of LH Meyer, Inc. Larry served as a governor of the Federal Reserve Board from 1996 to 2002. I note, Larry, that included the period of the tech stock bubble, the Asian and Russian debt crises, the collapse of long-term capital management. Interesting times. With a goal of bringing clarity to economic data and demystifying monetary policy making, Larry was professor of economics and chairman of the economics department at Washington University. He's a member of the board of directors of the National Bureau of Economic Research and the advisory panel to the Congressional Budget Office. Then we'll hear from Brad Setzer, who is a senior fellow in the Greenberg Center for Geoeconomic Studies, addressing global capital flows, financial vulnerability analysis, sovereign debt restructuring, and financial crises. Obviously, you've just been working at getting ready for today's discussion, Brad. He previously served as Deputy Assistant Secretary of the Treasury for International Economic Analysis, where he worked, among other things, on Europe's and Puerto Rico's ongoing debt crisis. Brad is the author of Sovereign Wealth and Sovereign Power, and co-author of Bailouts and Bail-ins Responding to Financial Crises in Emerging Economies. Finally, Desmond Lachman. Over his more than a decade at AEI, Desmond has written insightfully and extensively on the global economic crisis, the U.S. housing market bust, the U.S. dollar and the debt crisis and strains in the euro area, currency issues, and the global macroeconomy. And Desmond, I thank you for all the things you've taught me in those areas over our time together. Previously, he served as managing director and chief emerging market economic strategist at Solomon Smith Barney and a deputy director in the International Monetary Fund. Desmond and I have organized numerous conferences together, including this one, as well as recent discussions of the Greek and then the Puerto Rican debt crises. We never seem to run out of financial disasters. After their opening comments, we'll give the panelists a chance to respond to each other or clarify points if they wish, and then we will open the floor to your questions, and we will adjourn promptly at noon. Olivier, welcome, and you have the floor.
Thank you, Alex. Let me start with a warning, which I actually gave Alex before we started, which is I'm not a Fed watcher. I'll leave this to the others, which is a good division of labor. And so it's going to be more of a 30,000 feet type approach to the issues, which I think will be complementary to the most precise assessments that the other panelists can give. I don't know if it was Alex's doing or Desmond's doing, but we got a long list of questions. Which has kept me busy for the last 2 months. There is no way I'm going to answer all the questions, but I'm going to pick and choose and try to answer some of them. So, in your list, the first one was the question, in the title of the meeting, which is how should the Fed respond to what you called escalating emerging market country risks. And my sense is that it's a fairly simple job. The details, again, I leave to others, but conceptually, it's not very hard. What's happening, if you look at emerging markets, and there are two dynamics. There is the own China dynamics, which is different from many of the others, important but different. And then for most of the others, most are, not all, but most are commodity producers or oil producers, and that's what they are going through is the end of a commodity cycle with a sharp decrease in prices, not only for oil, but for commodities, as you know. And this has happened many times in the past. I think Desmond must have seen some episodes when he was at the farm. And it always is painful. And basically, you've organized your economy around high commodity prices, and they stop, and you have to reallocate. You have to change relative prices. You have to typically do a fairly substantial fiscal adjustment because some of the revenues came directly from the sales of commodities or indirectly. And so they are going for a tough time. So I think that's the characterization. What does this imply for the US? Well, it implies clearly lower growth and therefore lower US exports, no question about that. And they need a real depreciation in order to reorganize their economy. So put the other way, this puts pressure on the dollar on the way up. So there is a third factor, which is commodity prices are lower as a result. That's good for the US, but let's leave that one out. I mean, the response to lower exports and an appreciated dollar is basically to go more slowly with interest rates. And that's exactly what the Fed is doing. Now, again, I suspect some people will have views as to whether they are doing 1 month too early or 1 month too late. But it seems to me the response is a fairly straight one. If this happened to be a major break on, on growth in the US, well, then, we'll increase interest rates more slowly. So this was point one. I've now fulfilled my mandate in answering the headline of the other conference, but let me go to the other questions. So question two was, how did Fed policy affect the emerging markets during the crisis? So this is kind of the other side. What are we doing to them? And I think there's absolutely no question that it has been a very tough environment for the last 8 years or 7 years for emerging markets, with the main source being not so much the trade, but the capital flows and the back and forth, which took place a number of times. Now, I think the question, given that the question is about the Fed, is how much of these capital flows, both the going and the coming back, have been due to monetary policy. I think in a narrow way, not so much. I mean, if you look basically at the effect of changes in US interest rates or in QE on flows, you don't get much action. The variable which really comes in a big way is the VIX. The VIX is related to monetary policy, but it also has, unfortunately, a life of its own. And these bouts of risk appetite coming and going have to be explained by other factors. But that clearly has made, I think, the life of emerging markets much more complicated. Has the fact that monetary policy has been unconventional rather than conventional been an additional factor in making life difficult? I think so, in the same way as it has made life difficult for financial players, which is it has changed the relative prices of many assets and decreasing, for example, the term premium on long bonds or on some risky bonds. And this has complicated the life of people who are in the business of arbitraging between things. And it also has changed, I think, the nature of capital flows going to the countries. If you basically use the federal funds rate, then what happens is you don't know exactly, but you have a sense of what flows are going to come and go. When you start doing QE, which flows go is much less obvious. Footnote, I realize I should have said this about a minute ago. Another factor, which is much harder to quantify, but is clearly relevant, is that much of the movements in capital flows have been due to the banking crisis itself and to bank regulation. And initially, the desire by banks to basically take money back from their subsidiaries has played an important role. That's related to monetary policy, but not in a very direct way. Third point, the eternal Raghu Rajan question, which is, should the Fed have paid more attention to EMs and therefore changed its policy? And I think that the Fed has been very clear that its mandate is to do the best for the US. This doesn't exclude the room for coordination. In principle, there could be an equilibrium in which they can actually do better for the US and the others do better, but it is a bit harder than just asking them to be nice. I think the right answer here, there has been very little coordination, is the truth, except for fiscal policy in 2009. And my sense is the right answer of a right policy would not have been for more coordination, because when I was at the fund, I actually didn't know how to do it and what to do. But in a way, the problem of advanced economies was a lack of internal demand. And they couldn't quite use fiscal policy for reasons that are well known. And so they use monetary policy. And so when you do this, you have a low interest rate. That does good things to internal demand, but it also does something to the exchange rate. And so that was the problem, basically movements in capital flows and in the exchange rates due to the fact that monetary policy was the tool. What was the right reaction? Well, it may have been to use fiscal more, but there were limits. I think the right reaction, and I think there is a lesson for the future, is for the emerging markets to basically not maybe close the door, but let the door less open to capital inflows. I think if this happens again, it's completely acceptable and desirable for countries on the receiving side of capital inflows to say yes to these flows, no to these flows, and maybe we want less of a gift that you're giving us. And when this is done, then if it had been done, then there would have been the decrease in interest rates in advanced economies. There would not have been the large effect on capital flows, and the adjustment, I think, would have been smoother, both for the advanced economies and for the emerging markets. So my answer there is yes, it was tough, but the solution was probably not more coordination, but it was allowing countries to do something that they have been pressured not to do, which is to use capital controls and FX intervention. Fourth point, I don't know how long I've talked. Well,
You have 5 more minutes.
it's good. So question 4, are emerging markets in serious trouble, and is this going to lead to a global recession? And I think I know what Desmond's views are on this, but Desmond's views are always the same on this, so they are predictable. It's clear that they're having a tough time in some countries. I don't know if you get minute-by-minute news from Brazil these days, but clearly some countries are having a very tough time because the political implications are there as well. And so it's going to be tough for them. Is it going to be tough for us as a result? I'm very skeptical. The trade channels, as we know, are what comes to mind, but they are relatively limited. We'll have lower exports from the US. Again, there'll be some appreciation of the dollar, but as I've said, I think the Fed can handle it. The way in which things go bad typically is when the financial system, the US financial system, is affected. And I think there we can be reasonably confident that this is not the same as in the past. And the financial system is not exposed to bankruptcies as a result of countries going down the drain or anything like this. So my sense is it's going to be tough for them. It's going to be a bit unpleasant for us. But I surely don't predict anything like a global recession. 2 more, quick. So after having taken Desmond on, let me take the BIS on. So is the BIS right that the world is coming to an end in this particular time for corporate borrowing in foreign currency, which is their current line? On this, I think the original sin, which is that, is an issue. It is clearly making life much tougher if you want to adjust through the exchange rate, if you have large liabilities in foreign currency. I think there is no country where the second effect dominates. So on net, I think most countries still benefit from a depreciation, but it creates problems in the financial system and so on. Is it going to be catastrophic? I've left the fund 6 months ago, but before that they had done studies, and I assume they have continued. And the conclusion was that it was an issue. Some firms would probably go bankrupt. Any firm which is associated with commodity production and has a lot of dollar debt might be more in trouble. But again, this was not going to be a systemic issue. Last point, just a provocation. So this was your question about has monetary policy run out of ammunition? And we could spend the whole panel on that. My sense is from a technological point of view, surely not. And let me just put it provocatively, which is I think QE works better the more you use it, not the less you use it. It's very tempting just based on what has now been our genes to say if you use something more, it works less well. But you have to be careful about applying it to everything in life. That's not true of love. But I think it's not true of QE as well. If you think, take the simplest example in which you're buying long duration bonds, in which you start buying, and at the beginning you're going to basically buying it from people who don't care too much about being in long duration bonds. At the margin they had it, but if a price is unattractive, they'll move out, and so they'll be willing to sell at a price which is just a bit higher than the initial price. When you keep going, you get to holders, institutions, who have a lot of long duration liabilities on the other side and really want long duration assets on the asset side. And these people are very reluctant to sell, which is exactly what you want for QE, because the way it's going to work is that you'll have to offer a very high price or a very low spread, even a negative spread. You can think of some institutions being willing to hold long bonds at large negative spreads because they really want to be protected. So the more you, from a technological point of view, the more you use QE with respect to one asset or extending the set of assets, I think the better it works. Now, I think the constraints are political, which is as you do this, you may become too big a player in the market, or you may be intervening in a market where you're not supposed to, like the stock market. But if we leave this aside, I don't think that the Fed and others have run out of ammunition. I shall stop here.
Thank you very much, Olivier. Larry.
Alex, thank you for inviting me. And Desmond, thank you for organizing my talk with some very interesting questions, which I will selectively answer. And I want to start with where Alex did about what the FOMC did yesterday. But what they did is less in the statement than what they did in their forecast, okay, and what the dots told us. But we know that global developments have been extremely important, and you see in all talks by FOMC participants how important those events have been. We saw at the January meeting that the story was heightened uncertainty, much more concern about global risks, and that was an important part. They weren't going in January anyway, but it was setting up how the committee felt, and this was partly risk management, optimal policy under uncertainty, et cetera, et cetera. Okay, but now we come to the yesterday's meeting. Yesterday's meeting, if they're telling us what they really think, it wasn't about risks at all. It wasn't about risks. They didn't establish a balance of risks, not because of the uncertainty, but because some people thought were the downside, some thought it was it was balanced. The chairman identified upside and downside risks and said that the risks had receded since the last meeting. This was not about risks at all. This was about the baseline forecast, downgraded substantially. On the surface, you couldn't see it because it looked kind of like it did before. Yellen called it virtually unchanged. But why was it unchanged? It was unchanged because the worsened economic outlook was offset by a 50 basis point decline in the funds rate path through the end of this year and the end of next year relative to what they were thinking in December. Okay, I'm not going to go too much further than that. I thought it was a very confused meeting. I'd love to have been there. But basically, Yellen didn't explain why they revised it down. She explained it with a non-explanation, that the IMF had slightly revised down the forecast of rest of the world growth. That's rounding error, absolute rounding error. We're more like a closed economy than an open economy. We couldn't even tell it in that forecast. So what was it? The title of our commentary was Spooked. And you say, well, were they spooked by? Well, it's a good question. Psychological trauma from the events that took place earlier is all I can say, but we'll see what happens. Okay, now, so this is about emerging market risks and what should the Fed do? So we do have to remember that, as Olivier said, that it's the mandate of the Fed. This is a constrained optimization. The Fed doesn't set its objectives. Congress does, as government should for the goals. And they are full employment and price stability in the U.S., period. So sometimes I talk to central bankers and I tell them, I look at the person from Thailand and I say, oh, the Fed doesn't care about you at all. Live with it. Okay? They only care about you if you're screwing up so badly that you could damage the U.S. Okay, then they care. The way that the foreign developments, big international finance staff, yes. Exchange rates matter, foreign growth to a point matter, but foreign developments impact on the U.S. rarely through growth. They impact from the impact on financial conditions, global financial turbulence, which spills over to the U.S. in terms of worsened financial conditions. That's how big global events affect the U.S. I must say, it's a very nuanced story about how developments abroad are affecting the U.S. because the natural response is that, wow, we got an appreciation of the dollar. Net exports are taking half a percentage point off growth as far as the eye can see. But that's the theme. Domestic demand has to be strong enough to overcome it. But this is very nuanced. So why is the exchange rate rising when it has? Because presumably there are capital inflows in search of higher yield into the U.S. So they buy. What do they do with those dollars? What do they do with them? I presume they're investing them in the U.S. Now, let's just look at financial conditions over this period of turbulence. Credit spreads widened. The treasuries fell so much that investment-grade corporate bonds rates went down. They didn't worsen. They improved. Okay, very, very nuanced. All right, now the next question I want to take on is how responsible is the FOMC's unorthodox policy? Oh, words. Then there are two meanings of unorthodox. I had to ask Mr. Gould, but he was very frank. He said there are two basic meanings, and I have to ask Desmond what you meant. One is contrary to the usual expectations, unconventional, and the other was crazy, flaky, weird. So how are you using that? Okay, it's a rhetorical question. So the point is, what was non-conventional about U.S. policies? Well, what was unconventional was being at the zero bound. That was what was unconventional, unique, unusual. The Fed did what it always does. It aggressively eased policy, and I will call the policies not all that unconventional. They did open market operations like they always did, but they did them out on the curve. What was unconventional is they expanded the balance sheet, but that wasn't important. That was a side effect. The point is they took duration out of the market, lowered the term premium, lowered long-term rates, set off the transmission mechanism. And of course, communication. Oh my God, communication, it's a pillar of modern central banking. Okay, it was more aggressive. It was calendar-based, to be sure, okay, but needed under the circumstances. So unusual developments require unusual actions. And central banks around the world, what was unorthodox in the terms that, the pejorative terms? Well, the BOJ, they didn't understand what quantitative easing. They just let you stuff reserves into the system rather than take duration out. The ECB, where were they? Okay, now that was unorthodox monetary policy, not the U.S., not the Bank of England. Okay, and by the way, Bernanke had written the playbook many years ago, so the U.S. was well prepared. Okay, now the most interesting thing is the Fed responsible for mispricing across the markets? Mispricing is another pejorative word. Now, I think what Desmond means is that markets were responding irrationally. They were taking on more risk, and that could come back and bite us. But the Fed was doing what it always does. It makes safe assets so unattractive, short-term safe assets so unattractive that you got to go and reach for long-term. And make them so unattractive that you got to go out the risk spectrum. You got to buy corporate bonds. You got to buy higher yield corporate bonds. You got to buy equities. You got to buy foreign assets. We call that the transmission mechanism. That's what the Fed does, bid up the price of risky assets. Now, I'm going to leave as another subject, but a very interesting one, the role of monetary policy with respect to financial stability concerns. Much debated inside members' heads on the committee, across the committee, and there are many views about macroprudential policy versus use of monetary policy, but that is the more interesting question. Okay, what are we to judge about QE? Well, it worked. How much it worked, we don't know. We'll never know. Hey, we're economists. This is economics. I got data, I got models, I got judgment. I don't know anything, okay? I try to do the best I can. That's all I can say. What we do, I think, know from event studies and others that QE was very effective compressing the term premium, lowering long-term rates. I think that tells the story. setting off the transmission mechanism, and then we can argue about how effective monetary policy is in general in terms of stimulating aggregate demand. Now, Olivier said something very interesting about using it more rather than less. You know, when QE started out, Bernanke was very conservative. You may not think so, but he was very conservative. He said he was very conservative, and Janet Yellen said he was ridiculously conservative, okay? But he was because he thought there were costs, okay? And he measured the response. It was going to be less aggressive than it would have been had there not been costs. And then all of a sudden, gradually thought the costs were probably not as large as he thought, and he became more and more aggressive. Of course, the economy didn't do as well, which is part of it. I think the story is, I'd have a little different story about doing more. Any one-time change in monetary policy has a temporary effect on growth. If that growth doesn't bring you back to full employment, monetary policy is about repeat, repeat, repeat. That's what goes on with rates. That's what goes on with QE. How likely is the Fed going to raise rates? Well, it depends. It depends on the data. It depends on the forecast. They don't know. Their forecast, our forecast says they're going to raise it. Okay, gradually. Depends on how fast inflation rises. Depends upon the risk they're willing to take with respect to inflation. But another story for another day. Okay, so the next is, what should the Fed do in another slowdown? Well, this is very important. I'm sure Olivier thought a lot about this. We're in a different world today. We think we're in a different world. I have been very much influenced by Larry Summers and the secular stagnation hypothesis. I won't go to the extremes there, but here's the basic story. We're a slow growth economy, a slower growth economy, a very slow growth economy. Maybe potential output's growing at 1.5. Maybe we're lucky it'll grow at 2. The good news is we're never right about it, but let's say that's the story. It doesn't take much to tip us over into negative growth. Okay? Emerging market economies, when they're going 10%, they never had recessions. They had growth recessions. That's number one. Number two, we know that the real equilibrium funds rate today, or we think it's very low compared to what it was. That means the buffer between the average nominal funds rate and zero is much lower. That means you're more frequently going to be at the zero bound. And in terms of the way monetary policymakers talk about it, policymakers today are not as well positioned to respond to economic slowdowns or to pull the economy out of recession. And it's a question about whether or not you think these non-conventional policies are a perfect substitute, et cetera. I think the problem is they all may have greater costs, so some threshold of what you can use them without then turning to some other. So what should they do? The answer is be prepared. Research. How effective was what you did? Should you go to negative rates if you're at the U.S.? Are there alternative strategies that you could implement that can help respond to slowdowns and recessions? Every central bank around the world is worried about that, and they should be. So what's the prognosis going forward? Very slow increases in standard of living, very disappointing. Worse macroeconomic performance, more challenges for the central bank, more hope that maybe we'll get fiscal policy. And as Stan Fisher said, we always talk about no fiscal policy. We did get it. If things get dire enough, we'll actually even get some fiscal policy. But that's what lies ahead, I'm afraid.
Thanks, Larry. Well, I forecast a lively discussion. That's already been proven to be a good forecast, unlike many other forecasts, Larry, as you point out. Brad, keep us going.
So thanks very much for the invitation to join such a distinguished panel. I thought I would address 3 of the questions that were posed. One is sort of how threatening are emerging market vulnerabilities? Second, how much responsibility for the buildup of vulnerabilities should be assigned to U.S. monetary policy? And third, what should the Fed do right now? But I'm going to take them in reverse order. And I'm actually going to spend most of my time looking a little bit more granularly at some of the risk in emerging economies, because I'm pretty confident my comparative advantage here is not U.S. monetary policy. So first, what should the Fed do? And my answer there is very much the same as Olivier, exactly what the Fed did do, which is that in response to a weaker global environment, you would slow the pace of rate increases and thereby support the U.S. economy. If you go back and think about it, financial conditions in the U.S. have tightened quite significantly, even though the Fed has only raised U.S. interest rates, short-term U.S. rates, by 25 basis points. Why? Because the path of monetary policy outside the United States has changed quite significantly. And even though we are a relatively closed economy, we're not an entirely closed economy. And with the dollar relative to the middle of 2014, last I checked, and it moves around a lot, was up about 17% in real effective terms. That alone generates a pretty significant impact on the U.S. So the standard rule of thumb in the Fed's models is that a 10% real appreciation leads to a 1.5 percentage point fall in net exports over, say, 6 quarters. You can come up with slightly smaller estimates of the impact, but I think that's a reasonable estimate. The implication of that is that the rise in the dollar will lower net exports by around 2.5 percentage points of U.S. GDP, which is a pretty substantial drag. Leo Brainerd noted that net exports subtracted 0.5 point from U.S. growth in 2014, another 0.5 point in 2015, and it could subtract as much as a percentage point this year. So to maintain an acceptable pace of U.S. growth, to continue to maintain relatively tight labor market conditions, U.S. domestic demand has to be relatively strong. And when you look at the U.S. economy, I think one of the surprising things is that the oil shock hasn't generated more of a positive impulse. I went back and looked at U.S. Consumption growth as a contribution to GDP, and looked at it on relative to on a fourth quarter of this year versus fourth quarter of last year basis. In 2014, in the fourth quarter of 2014, consumption growth was contributing more to U.S. growth than it was in the fourth quarter of 2015, even though oil prices had fell by over 50% over that period. So you did not see the expected strengthening of the consumer. Now, maybe that was because in 2014, there had been a pickup in U.S. consumption growth, and so the base was relatively high. But if your baseline forecast was that consumption growth would pick up even more because of the fall in oil prices, that did not materialize. And it's a little bit of a risk to assume that it will materialize this year. What did materialize unambiguously, as a result of some of the positive stories in the U.S. economy, the fact that we have become one of the biggest oil producers in the world, but we're also one of the high-cost oil producers in the world, is that there was a very sharp reduction in investment. So investment in the oil and gas sector subtracted 50 basis points from U.S. GDP last year, and based on the rig count and the further fall in oil prices, there's likely to be a further contraction. So faced with this constellation of possibilities, with a very substantial drag from net exports built in, and without as strong as you might have expected an offset from lower oil prices, I think it is reasonable to recalibrate the pace of Fed tightening. I wanted to note quickly 2 little things here. One is that the monetary easing that we've observed around the world has by and large come from countries that are benefiting more from the oil shock than we are. Europe, Japan, China import a much higher fraction of their oil than we do. So if there is any set of countries that should be booming and raising rates simply as a result of the commodity shock, it is them, but that is not what we are observing. The second observation is that the contraction in external demand in some of the commodity exporting countries has been quite sharp, kind of the sharpness that one typically associates with a financial crisis. So Russia is obviously a little bit of an extreme case, but Russian non-petrol goods imports were down over 30% last year. That's a pretty big fall. Brazil, again, using the same metric, non-petrol goods imports, were down well over 20%. And if you look at higher frequency indicators, they're moving quickly towards a fall of over 30%. These are big moves. Now, the fall in Russia doesn't have a huge impact on the U.S. economy. We actually export a fair amount to Brazil. And if you look at how U.S. exports are performing on a comparative basis, U.S. exports to South America are falling faster than U.S. exports to other parts of the world. So we are already, in some sense, feeling the effect of weakening financial conditions in emerging economies. Second, how much responsibility should we assign to the Fed for this slowdown? And my headline answer is it's more China than the Fed. And it is more of a current account shock than a capital flow shock. So let me go back and explain that a little bit. Olivier, I think, made a very good point, which is that when we think about the constellation of policies in the US and in Europe, because Europe's a pretty big place too, that impact flows to emerging economies, bank regulation also plays an important role. So if you compare capital flows to the emerging world at their post-crisis peak in sort of 2010, early 2011, to their pre-crisis levels, so they're 2007, so forth, they're actually higher a little bit before the crisis than they are after the crisis. What changed? Well, portfolio flows increased after the crisis, but cross-border bank flows went down because of the tightening of global bank regulation. So in some sense, the advanced economies were, through their bank regulatory policies, putting something of a brake on some subset of flows to emerging economies. Now, I agree very strongly, though, with Olivier that part of the response on emerging economies, particularly those with large deficits that were receiving large inflows, reasonably should have been prudential measures on capital inflows, and there was probably more scope to use that than was done at the time. But I do think it is important to recognize that capital flows are a function of interest rates, but also a function of regulation. The second point I'd make here is that the peak flow to emerging economies kind of came pretty fast after the crisis. By 2011, there was in Olivier's terms, a VIX shock that came from Europe that led to a slowdown in the pace of inflows. They kind of recovered in 2012. And then in early 2013, there was the taper tantrum shock and another material slowdown in flows. So there hasn't been, in aggregate, a continuous wave of capital flowing from the advanced to the emerging economies over this period. And many emerging economies were under substantial pressure to adjust after the taper tantrum, even before the Fed started its tightening cycle. Third point I want to make here is my commodity point. These numbers are going to be a little bit off because they're a little bit old, and I haven't updated them to reflect the latest moves in the global oil market. But they're also maybe a little bit understated because a lot of commodities other than crude trade off the price of crude, notably natural gas. But when oil was at about 100, the world was spending about 4% of its GDP on oil. That has fallen to maybe 1.5 percentage points of world GDP. That is a material global shock, but it is a decisive negative shock for many commodity exporters. And if you look at some other key global commodity prices, the one I'd like to follow most is iron, because it matters a lot for Brazil. The price of iron, raw iron, is about a third of what it was during the peak. So I completely agree that emerging economies faced a very difficult set of conditions in the immediate aftermath of the crisis, but that difficult set of conditions came in part from very strong commodity prices that were leading to pressures to overheat in a lot of the commodity exporters that were augmented by capital inflows that were seeking out the high growth that one observed often in commodity exporters. So fundamentally, it was a difficult challenge of managing what turned out to be a commodity price supercycle that I think a lot of emerging economies didn't handle necessarily all that well. Third, vulnerabilities. I want to talk about vulnerabilities in 4 countries, not partially because they're big and interesting, and partially because I think they illustrate the types of vulnerabilities are there. And the aggregate argument I will make is that when you drill down, the story isn't quite as bad as the BIS makes it out to be, but it's not great either. First story is China, because I think it's big, it's important, and I have a slightly different take than many. China's core problem was not the Fed. China's core problem is that it saves too much. China managed the consequence of the global crisis, given its very high level of savings, by ramping up investment. And now, with a desire to ramp down investment, and with savings still relatively high, there is a persistent risk that China will experience a shortfall of demand. I emphasize the high level of savings because even at the peak of China's investment boom, it was running a current account surplus. And I emphasize it because the good scenario, at least in my view, for the world doesn't come from a fall in Chinese investment, which is, after all, a fall in demand. It rather comes from a fall in Chinese savings, which would naturally bring down investment while keeping Chinese demand relatively high and avoiding a big rise in China's external surplus. Now, there is a debt story associated with China, and a lot of the increase in dollar debt globally comes from an increase in borrowing by Chinese companies and banks. But it is important to recognize that China's external debt started from a very low level, and China is a very big economy. So a very big increase in dollar terms isn't all that big relative to China's very large economy. At its peak, best I can tell, China had accumulated about 1.5 trillion in external foreign currency debt, and about 1 trillion of that was short-term. That came from a country that, this has lagged a little bit, so I lagged the data at that time, had 3.5 trillion in reserves. So ballpark, China could have repaid all of its external debt and still had 2 trillion in reserves left. And 1.5 trillion is like 15% of GDP. The external debt story, the dollar debt story in China, to me is not the central element of China's vulnerability. The central element of China's vulnerability is the risk that China's exchange rate management will be unsustainable and that China will look to rely more on net exports as investment slows if savings doesn't fall at the same time. Second country that I want to mention, because I think it's an interesting archetype, is Turkey. Turkey is one of those strange countries that has Asian crisis-style vulnerabilities, but never seems to experience an Asia-style crisis. Ongoing current account deficits, and it's the one country in the world that has more short-term debt, one major emerging economy in the world that has more short-term debt than it has reserves. So it continually seems to be running risk. There is a debt in the corporate sector, but the run-up in debt has been much more in the banking sector, and much of it in complicated chains of intermediation has supported a boom in consumer lending. So you kind of think Turkey's ripe for a crisis. The problem is Turkey's been ripe for a crisis for a long time. The short-term debt seems to be relatively sticky. And if you're going to worry about risk at the current moment in time, you're probably going to worry more about a commodity exporter than a commodity importer. And Turkey is a very big commodity importer, and its current account deficit is coming down. So it's an interesting case. It has an ongoing set of vulnerabilities, but there hasn't been a trigger for a crisis. There's corporate vulnerabilities, but the real vulnerability, in my view, is in the banking sector. Third one, and I'll be really quick.
You have 2 more countries, but you only have 1 more minute.
I can be amazingly quick. Venezuela, it's hardly worth talking about. But it's a simple case where oil prices have collapsed, debts remain, there isn't enough export revenue to service the debt, something will have to give. Final case, interesting case, Brazil, which I expect Desmond will want to pick up on. Brazil's interesting because Brazil's government no longer has significant dollar-denominated debt. Brazil's government has very significant, or maybe significant dollar reserves. So Brazil's government, in a balance sheet sense, benefits from the weakness in the real. Foreign investors bought Brazilian local currency debt. They've absorbed a lot of the shock, and in some sense, the system worked. Brazil was able to use the exchange rate to adjust. That oversimplifies a little bit, but it captures something. Flip side, Brazil has a decent amount of corporate debt, but a lot of that corporate debt, when you look at it, maybe isn't so corporate. Biggest borrower by far is Petrobras, a state-owned oil company, and I think that is in some sense typical of the rise in dollar-denominated debt. When you start to drill down and look at it, it appears to be one step removed from the sovereign, but it's only one step removed from the sovereign. And I think one of the key questions going forward is how to handle the quite large foreign currency debts of state oil companies in a world of low oil prices. Desmond.
Thank you very much, Brad. Desmond.
Thank you, Alex, and thank you very much for helping organize the seminar. It's generally a disadvantage to speak last because generally one's got nothing left to say, that the panelists have said it all. In this case, it's a particular disadvantage in that the panelists have already taken away from me the surprise element of what I might have to say in indicating that I don't take quite as sanguine a view of the world as do they. So what I'm wanting to talk about is I'm wanting to talk about the Fed and the emerging markets. But before I do that, I should just preface it by saying that the way I see the world is that there's an unusual confluence of risks right now. I'm wanting to talk about the emerging markets because I think that they're important, but that shouldn't blind us to the fact that there are plenty of risks elsewhere in the world. We've got in June a referendum on Britain's continued membership in the European Union that could have really very big systemic effects if they make the wrong decision, that we've got problems in Japan, that Europe has got endless problems. So this whole emerging market saga is playing out against a backdrop when there are plenty of other risks. And I want to agree very much with Larry in that when he says that the problems that you get that affect the United States are through the financial markets, I think that that is true, and I think that that's where the emerging markets really have an influence on the way that U.S. monetary policy should be set. So I want to start just by saying that I see that there's a very strong interlink between the emerging markets and the Federal Reserve in that the way in which the emerging markets perform, that influences the state of the global economy. That has a bearing on the United States economy, so that should have a bearing on Federal Reserve policy. Meanwhile, Federal Reserve policy has a bearing on what the conditions are like in the emerging markets. So the interlinkages go both ways. Now, we've really got to look at this in quantitative terms. What has happened over the years is that the emerging markets have become so much more an important part of the global economy. This chart is indicating that in 1995, China was a mere something like 2% of the global economy. Today, it's something like 12%. If you take the emerging markets in aggregate, you're talking about something like 40% of the global economy. So what happens in the emerging markets does have relevance and might not directly impact the United States, but it impacts what the conditions are like for Japan and Europe, and that way it comes back to the United States. Now, to Larry's point on financial side, and this is one of the reasons that I'm concerned, is that emerging markets have gone on a borrowing spree the last 8 years or so. So if you look at the size of their borrowing in dollar terms, you've got something like $6 trillion of corporate debt in emerging market land. And just to put it into perspective, that is something like the size of the United States high-yield market. So if things go wrong in that market, I would expect that that would have impact on the financial markets. Now, to Larry's point as to the meaning of orthodox, I think that it is unorthodox when one sees the Federal Reserve balance sheet, that the Federal Reserve took a mere 100 years to get its balance sheet up to something like $800 billion, but it only took 7 years to go from $800 billion to $4.25 trillion. And that wasn't the Fed alone. That was, amplified by what the Bank of Japan was doing, Bank of China, and lately the European Central Bank. Now, the impact that this has is, I agree that developments in China were very important in the commodity cycle, but that is another way in which monetary policy works, encourages people to take risks. So what we got is, from the emerging markets point of view, we got a super cycle in commodities that, if you just look at the index, goes up from something like 100 to 75, and that the capital flows that went to emerging markets are, in my mind, staggering. This chart from the Institute of International Finance just shows that for something like 4 years, the green lines, which is non-resident capital inflows, are amounting to something like $1 trillion a year. So this really complicates the life of the emerging markets, and this is basically the problem that Raghuram Rajan is talking about, is that the emerging markets aren't in the position to use that capital well, and they actually mismanage it. So what occurred is that many of these emerging markets, what you saw is their currencies strengthened like crazy. They begin to open up very big current account deficits. I'm thinking of places like Colombia, Turkey, South Africa, Brazil, Ukraine. All of those countries had current account deficits 4, 5, 6% of GDP. And then what really worries me is that those conditions allowed emerging markets corporates to go on a massive borrowing spree. So what we see is emerging market corporates that they had something like $10 trillion in debt around about 2010. It's now something like $23 trillion in debt. So in my view, you've had a huge credit bubble amongst corporates, and it's not confined to China. This is many of these countries, Russia, Turkey, Brazil, and so on. They've all run up huge debts. What's worrying the Bank for International Settlements, and it certainly worries me, is that the dollar debt that these corporates have taken on has gone up from something like $2 trillion to $5 trillion. So what this means is when the currencies depreciate, those corporations find out that they borrowed at very much higher rates than they thought they did, which really leads to a big squeeze. Just another way of putting the corporate debt problem in the emerging markets is that if you look that in relation to GDP, we've gone up from something like 60% of GDP to 90% of GDP. So in my view, you've got a real problem brewing on the corporate debt side, where we're going to get a wave of defaults. Now, what's happened since the Federal Reserve stopped the idea of printing money, what we've had is we've changed a change in liquidity conditions, and this really impacts the emerging markets in a very bad way. To put this chart up again, the IIF has indicated that this is the first time in about 25, 30 years that we're seeing capital outflows from the emerging markets. So this money is now going back to the United States, and what that is doing is it's putting huge pressure on the emerging market currencies. So what you've just seen is a collapse in currencies on the emerging market side, which complicates the debt problem for the corporates. That you just look at places like Russia, Brazil, all of those places have had their currencies move by something like 50%. Similarly, as liquidity conditions change, what we've now had is we've had a bust in the super commodity cycle. So these countries are already very pressed on the export side, and it's little wonder that they're now slowing down. The cost of borrowing for these countries is now going up, which is another way in which they're impacted. So in short, I don't think I can take a complacent view of the emerging markets and their impact on the global economy, and hence on the way in which the Fed is going to have to raise interest rate, have to deal with the change situation, both because it's going to be through the trade channel, in that you're going to have a global economy that's less buoyant, that's going to impact on United States exports. But I'm concerned that there's somebody on the other side who has made those loans of the $5 trillion in dollar terms to these emerging market corporates, and it's just going to be a matter of time before we see defaults and before we see real strains. So the places that I'm really concerned about are two of the markets. I'm not going to talk about these countries like Venezuela and Ecuador that I expect to default, or Puerto Rico and so on. That'll just be the backdrop. The two ones that I'm really concerned about is I'm concerned about China, and I'm concerned about Brazil. This chart just illustrates, part of the reason that I'm concerned is that in the official statistics themselves, you see a sharp slowing of China, but most analysts who look at China don't buy that. They say that, you look at other indicators from the bottom up, electricity consumption and so on. China's economy is probably growing at 3%. What I'm concerned about on China is it's staggering that $1 trillion has left China in terms of capital flight, which indicates to me that something all is not well in the Middle Kingdom, that people are wanting to take money out at that pace. But the real thing that worries me about China is this chart. This chart shows private debt bubbles. In China, this is the case of corporates and state enterprises. And what this chart does is it's comparing the red line on the left is China over something like a 5-6 year period. The blue line is the United States before its housing bubble, and the black line is Japan before its crash in the late 80s. So what you see is that China, the credit is really just zooming, that you've had increase in corporate credit by something like 90% of GDP in the space of 5 or 6 years. That normally tells you that you're going to have problems. Of course, what the Chinese can do is they can kick the can forward, as can the Fed through additional quantitative easing. They can kick the can forward, but that just makes the day of reckoning a whole lot worse. Brazil's problems are really of concern, because here you're talking about something like the 7th largest economy in the world, the major economy in Latin America. The story on Brazil that I'm concerned about is that, aside from the political chaos that's going on there, is that the economy has contracted now by something like 8% over the last 6 or 7 quarters. You're talking about a major depression. Now, if you've got a lot of corporate debt, your currency is going down the tank, you've borrowed a lot in dollars, you've got your economy going this way, it's only a matter of time before we're going to have non-performing loans all over the place, or before the sovereign is going to have to take over this and have to bail out the banks. So on that side, we're seeing that the Brazilian deficit is already at 10% of GDP, and their debt, the sovereign's debt, has gone up from something like 50% to 67% in the space of 2 years. It's on its way to 80%. You're going to have to add to that the 15 or 20% of GDP it's going to cost to bail out the banks and to bail out. So for all of those reasons, I can't be very complacent. I realize that optimism isn't one of my strong suits. But let me just say a last word about the Fed. You know, that I'm just reminded of what Rudy Dornbush famously said about the Bank of Mexico. He said about the Bank of Mexico that he could understand they're making mistakes. You know, because after all, the people at the Bank of Mexico were human, and humans make mistakes. What he couldn't understand was the same people making the same mistakes time and time again. And, you know, I think that the quantitative easing at that pace, what it does is it solves your problem. It works in the short run, but what you've really got to be looking at is what is the consequence of the quantitative easing from a long-run point of view. And I'm suggesting that what the emerging markets are showing is one of those unintended consequences, that you get all sorts of distortions, all sorts of excesses, and that when you begin to try to unwind it, the whole house of cards collapse. So to react to this by another round of quantitative easing, in my view, would be a mistake. My solution would be it's time to bring in the helicopters to begin dropping the money around, you know, so that we don't mess up the asset price markets. But I guess my view is a minority view.
Thank you, Desmond, and thank you to all of the panelists for really interesting discussions. Now, I'd like to just go back down the panel in the same order and give everybody 2 minutes, or let's say maximum 3 minutes, for any reactions or additional comments you might have. Olivier.
2 minutes or no? Because it's full of... You can have three. Well, let's start the bargaining. Let me then choose. So with respect to Larry, I do not like the use of mispricing, and I think we agree. I mean, QE has changed spreads. Now, whether the spreads were the right ones to start or not, they depend on regulation, they depend on what the Fed is buying, is selling. So I think we have no sense of what's... So I think we have no sense as to what the right spreads are. They are different, but whether they're worse or better, God knows. The argument that, and that's not an argument you made, but you raised the issue. Some people say that QE is basically an alternative. We've learned we can use it, so we don't have to worry about the zero lower bound anymore. My sense is no. I mean, we use QE because we didn't have a choice. But it introduces, if not distortions, at least a lot of changes in the financial system. And I much prefer to return to a policy rate being the federal funds rate and having the ability to use it. So this raises the issue of the rate of inflation, which I've discussed it many times in the past. Brad, and this is really just factual points. On consumption growth, it's true that consumption hasn't done great, but there's this really nice study by JP Morgan Chase Institute, which is based on 5 million customers they have, in which they can follow consumption and income. And it's very convincing in showing that people spent about 80 cents of the dollar they saved on oil. There were other effects, so when you look at aggregate consumption, you don't see it, but people spent it. Something else happened. Just one point on China. I think you're completely right that the big issue is saving, largely personal saving. But there, I think we can be optimistic because precautionary saving comes, it's mostly precautionary saving. It comes from the lack of health insurance, retirement, and so on. They are putting it in place. And so I would expect consumption growth to be fairly strong. By implication, if this is the case, they don't need to depreciate. They don't need to do other things. On Desmond's point, again, I'm choosing. So if you look actually at a granular level, you find that a lot of the FX liability exposure is in firms which are selling in dollars. So that doesn't quite solve the issue because if they are selling commodities, they still have a commodity risk. But at least the currency risk is much less than you think. So what I said about not being terribly worried came from this kind of gradual assessment which we had done at the fund. Listening to Desmond, I mean, I thought we actually agreed on the analysis, on the facts, very much, but we agreed on conclusions. I mean, I look at all these facts and I conclude that emerging markets are going to have a really tough time and many firms are going to go bankrupt and so on. But I don't conclude that this is going to create major problems for the advanced economy financial system. that the claims we have on these countries basically are not so large that this will change. Again, semantics and the power of words. You don't want to kick the can forward. And I completely agree that when we're talking about evergreening, so what happened in Japan or what happens in China now, that's kicking the can. It doesn't solve the problem. To describe QE as kicking the can forward, that's completely wrong. It's just completely wrong. It's like there are times when you want to have a low interest rates for cyclical reasons. It's not kicking the can forward. It's waiting for the time when the economy will pick up on its own. And can I say just one more thing on helicopter money? It's a joke, helicopter money. It's a scam, right? Helicopter money, I mean, there is one version, which is, the central bank sends checks to everybody. It's not the way it's going to happen. The way it's going to happen is that there's going to be a larger deficit financed by bonds. Bonds are going to be bought by the central bank, which is going to issue money. And so in the end, it's the same, not maybe from a psychological point of view, but so it is fiscal policy, financed by money. In a world in which money and bonds pay zero, if you forget expectations, it doesn't make a whole lot of difference. So the whole difference comes from on the day where the interest rates increase, are we going to keep the money stock high? Or are we going to decrease it and change it to debt? If we keep money very high, there'll be an inflation tax in the future because the price level will have to adjust. Or we'll have to increase required reserves on banks, so this will be a tax on banks. Or we'll pay interest on excess reserves, which is just like paying interest on bonds, and therefore this will be just like debt finance. So to the first approximation, the discussion should be about fiscal policy, and the whole helicopter money stuff should not be part of it.
Thank you. Larry.
All right, I have a couple of points for Brad and for Desmond. Now, as Desmond said, I mean, we know that primarily the appreciation of the dollar, to the lesser extent global growth, is weighing on the U.S. economy. That's why we're projecting a drag from net exports. And the kind of numbers he used are just Forbes kind of numbers, so it's nothing is a surprise. My numbers will be a little bit different. I think exchange rate has longer legs and impacts the economy for a longer time. But that's why the Fed has anticipated a historically low pace of rate hikes, half the measured pace, incredibly, and leaving enormous accommodation in. Enough? Well, that's a question that I suppose we'll find out. So the recalibration of monetary policy, they have calibrated monetary policy to reflect the weight on the economy from global developments. So the question is the dollar going to rise by more than they anticipate? Will they have to recalibrate? Okay, that's a possible question. Now, with respect to...
Can I do a two-hander on this?
Sure.
Because you said,
Yes.
Because it's directly relevant. You said, well, they seem to have, the IMF forecast hasn't changed. So where do they get...
Yes.
Well, the IMF forecast was based on the same assumption they did, which is that the IMF forecast assumes that the Fed was not going to increase interest rate as much. No, but it's true. I mean, it's a fact, right? So basically, the IMF forecast comes out like the Fed forecast, but it reflects the fact that they both thought that the economy was weaker, and therefore there was going to be less adjustment of interest rates.
Okay, so then I have a question for you. Okay,
It's free.
why was the IMF forecast weaker? Okay, why was it downgraded in the absence of rates so much? And please don't tell me because of slightly slower global growth. Okay, it's a rhetorical question if you like.
Okay, I will not.
Okay.
I don't answer.
All right. Okay. Now, with respect to Desmond and the balance sheet, I think the best way to think about the balance sheet is it's just a sideshow. Okay? You're taking duration out of the market, you're lowering the term premium, lower rates, and then you go on from rates to financial stability concerns. That's fine. Okay? This is about rates. Okay, the story about the balance sheet is makes it harder for the Fed to raise rates, but it has come up with operating procedures to take that into account, and maybe there are other costs. And what I take away, Desmond, is that you're really talking not about what the Fed should have done, should do, but what emerging markets should have done, could have done, that would have put them in a better place to withstand the problems that they now have. Now, I'm not as much of an expert on emerging markets, but I think that's a very good question. Look, if the world is as grim as Desmond say, then monetary policy will be recalibrated to take it into account. Will it be able to do much about it? No, not really. Okay, sorry. I mean, that's the world we live in. So it's a bad story if that develops. Oh, and helicopter money. Let's be sure we understand how Bernanke defined helicopter. I mean, helicopter Ben. He defined it in the modern world, not dropping money from helicopters, but exactly as Olivier did, money-financed fiscal stimulus. Okay. And what's important there is really the fiscal stimulus. Okay, a little difference between bond-financed and money-financed, but it's about fiscal policy.
Thank you. Brad.
So let me see if I can make 4 points in 3 minutes.
That's 45 seconds apiece.
So the first point is about the Fed, and I think it is, and January and assessments of risk. There is an obvious nonlinear risk that is difficult for the Fed and for the IMF to model, which we were all reminded of in January, which is the possibility that China's exchange rate regime might change suddenly and in a disruptive way. And China is big enough that even if, I kind of agree with Olivier, that if China does the right thing and introduces and expands the social safety net, bridges to that lower level of household savings with an expansionary fiscal policy, there is no need for a country that is running a very sizable trade surplus to devalue. There is still a possibility that China might devalue, and that is not unrelated to the path of the dollar. And I think that's a kind of a binary risk that is difficult for the Fed to incorporate effectively into its forecast. The second point is a little bit of a response to Desmond. There's no question that China's corporate borrowing has soared. I don't think that has much, if anything, to do with QE. I think that has everything to do with domestic regulation and policy inside China. China just went from, with a very high level of savings, essentially financing a U.S. consumption boom before the crisis, to financing a very rapid surge in investment in the corporate sector and in the state-linked corporate sector after the crisis. That debt is predominantly held inside China. There are relatively few linkages to the global financial system. So I don't see how you can get a financial crisis out of China. I very easily see how you could get another major negative shock to global trade out of China. Foreign currency debt. There are two countries which pose possibly systemic risk from the foreign currency debts of their corporate sector, setting China aside. One is Russia, the other is Brazil. We looked, back when I was speaking of we as the U.S. Treasury, really closely at Russia's state corporate debt, or Russia's corporate debt. The key foreign currency debts in the Russian economy are in the state banks and in the state-linked oil companies, Rosneft and Gazprom. The foreign currency reserves of Russia 2 years ago exceeded the foreign currency debt of the Russian state banks, and the Russian state oil companies. And what we have observed over the past 2 years is a very large reduction in the foreign currency debts of the state-backed companies, combined with a big fall in Russia's reserves, but no global financial disruption. And Russia, as a result, partially of the sanctions that the U.S. introduced, partially because of global market developments, has chosen to compress its imports at an incredible pace to remain in a current account surplus, even with oil at $35 a barrel. So with that constellation of facts, I don't quite see how Russia's state-backed companies are forced into a default. Brazil is a very interesting case because it's a very complicated case, and I probably can't address it in the remaining amount of time. But if you add the debt, foreign currency debt of Petrobras, to the foreign currency debt of the government of Brazil, and Petrobras has more foreign currency debt than the government, throw in the state-linked banks' foreign currency debts, and deduct from Brazil's reserves their foreign currency swap book, which is about $100 billion, Brazil also, taken an expansive interpretation of its debt, has more foreign currency reserves than it has foreign currency claims directly on the government. So I am very bearish. One cannot but be bearish about Brazil, but it doesn't necessarily follow from that there is an imminent default that will be systemic and disrupt the global financial system.
Thanks, Desmond.
Just a couple of points. Of course, I agree that the way in which helicopter money works is through fiscal policy, and that it's the central bank financing it on very easy terms. But I view that as preferable to using more quantitative easing, which has unintended consequences on the asset price side that subsequently we repay. So I'm not talking about it kicking the can forward. I'm just saying what you're doing is you're building up, as we've done before, whether it was with the housing bubble, now with these kind of bubbles, what we're doing is we're solving a short-term problem by creating for ourselves a big problem. And I think that is something that I wouldn't want to repeat. Just on the issue of China, what I think one has to do is look at China in a global context, and you've got to look at it in a context where everybody, be it the Bank of Japan or be it the European Central Bank, what they're all doing is they're desperately trying to cheapen their currencies. If we get something like a Brexit event, or if we get China moving its currency in that kind of environment, you could really open up real problems in terms of a currency war, and that's what really worries me. So, just on the China side, I don't think that it's the fact that they borrowed $1 trillion in dollar terms that is of concern. What's of concern to me is that $1 trillion is leaving this economy. This economy is slowing. I don't see how they engineer a gradual path of exchange rate moves. As soon as they begin moving the exchange rate, what they're going to do is they're really going to fan the capital outflow. They're really in a very difficult box, and the international environment is very difficult. I don't know how it plays out, but to me, this looks like it's a really very big risk.
Thanks, Desmond, and thanks to everybody. I'd like to ask a couple of questions to the panel. Olivier made an unorthodox suggestion, and Larry, unorthodox means different from the prevailing orthodoxy of the moment, because orthodoxies move with time, and central banking orthodoxies in particular are notable for moving with time. But
being crazy.
it may or may not be crazy, but it's different, that we know. The unorthodox suggestion was that emerging markets ought to put on capital controls, particularly for controlling inflows in boom times and times when a lot of monetization is taking place in say, the U.S. Brad already said that he agrees with that one of the steps for the next time around would be for such controls. Larry and then Desmond, do you agree with that suggestion or not?
I absolutely and happily defer to Olivier. Okay, so if he says so, I believe it.
Is he supposed to be a panel discussion?
No. It's comparative advantage.
You are the new orthodoxy, Olivier. Desmond.
I think that capital controls on the inflows would be a good idea. I'm just not sure how likely that is to occur, because when you're getting the capital inflows, this is allowing you to have the kind of party that, all politicians would like to have. That I think it's a question when the capital begins flowing out, that's when, you'll get the capital flows to avoid a crisis. So, while I think from a conceptual point of view, it would be very good if they had capital flows, that they didn't bring in this money, then they might have avoided the problem. The only question, though, is where would that money have then gone? So instead of creating the bubble, on the emerging market side, presumably you would have had high yield spreads going into negative territory or something absurd like that. But just to go to the question of mispricing or misallocation of capital, I was struck on this cycle. I don't want to mention the countries in Eastern Europe that were really extremely troubled, or the ones in Africa that had never been to the bond market before, and suddenly they can access these bond markets at something like 5 or 6%. That is just, in my mind, nuts. Likewise, in the high yield market, if you know that the interest rate goes down to a level that is totally inconsistent with the historic rate of default, then maybe there is some mispricing in an objective sense. I'm not saying that the markets are irrational, because they're following short-term incentives, but we get those kind of distortions that get unwound, which has pain when it occurs.
It's certainly, yes, you sure can.
Can I just caveat my endorsement of inflow controls by noting that I think rather differently about inflow controls in a country that is running a current account deficit like Brazil in 2010 and 2011, where there's a consumption boom taking place at the peak of a commodity cycle, than I think about inflow controls in a country like, say, Korea, which had a current account surplus and was fundamentally trying to reduce pressure on an undervalued currency to appreciate.
Yes, go ahead.
So you say that I was deviating from the orthodoxy, but I think the orthodoxy has moved. If I'm right, the fund has written a number of papers going from never to last resort to part of a toolkit to, well, why don't you do it? Something like that. So I don't think we're quite there, because we actually don't know the usual issues, which is, the criticism is that they don't work and they introduce distortions, which is a bit contradictory, but that has been the line. And I think because governments have been very reluctant to use them because of the social pressure, in a way. If you want to be invited to Basel, you don't use capital controls. So I think we have a lot to learn. But I think that, again, having cyclical, in a way, capital controls on specific flows is the way to go. I agree that it can be misused, like manipulation of the exchange rate, the old discussion. On the outflow, I'm much more skeptical. I think that once you've let the capital come in, unless you were explicit about the fact that ex ante there was going to be a tax when going out, I think there you basically have to let them go out. You should have been more careful on the way in. And I think the depreciation you get from that, Brazil is, many other things are happening, but there is no question that things would be much worse in Brazil if the depreciation had been smaller. So I think the depreciation really helps on the outflow side. It creates other complications if there are balance sheet effects. But I think the orthodoxy has moved.
Thank you. Now, speaking of inflows and outflows on this topic, Desmond, could you put this chart up again? Emerging market flows, because something struck me about this chart which we did not yet discuss. If we can get there, that one. The green on the top are the inflows from the rest of the world, and the blue on the bottom are the outflows from the markets. Now, this looks to me like net. Basically, the rest of the world is financing the locals getting their money out, which is a familiar pattern. That was exactly the pattern that built up in the late 1970s and early 1980s with what we called emerging markets, less developed countries, with the developed country debt. So you had this big inflow of constant new lending rolling itself over and making new loans to pay the interest on the old loans, financing the outflows from the locals in these markets. And that, to me, looks like exactly what's happening here. And of course, then when the inflows stop, you have a problem. Another thing we might ask is, where do the outflows go? Well, we know one of the places they go is into U.S. and Canadian real estate. So if I mentioned in my remarks, one of the things we're seeing is a tremendous re-inflation of real estate prices, residential, but more particularly commercial. And I guess this, I would hypothesize this is one of the reasons for that, what you're seeing here. I have one other question, and then, ladies and gentlemen, we're going to come to your questions. Olivier mentioned the original sin being borrowing in a hard currency because it seems cheap at the time, which will have to be financed with your soft currency income someday. That's the same thing that the Hungarian homeowners did, who took out Swiss franc mortgages to buy their houses in Hungary, and of course greatly regretted it, and we see that over and over. But there's another original sin, as we all know, and that's a mismatch of duration. So Larry has pointed out rightly that what the Fed did was suck huge amounts of the long duration into itself, suppressing the long rates. Now, again, if we look back to the 1980s, think about the classic duration mismatch of the savings and loans with old fixed-rate assets, floating-rate liabilities. We get the tremendous Volcker interest rate peak, and all of the savings and loans go broke. It strikes me that as the Fed has, and the ECB and so on, have sucked out duration, they create a sort of mirror image savings and loan crisis in the people who have fixed rate, very long liabilities and now have no ability to fund them with the matching fixed rate assets. And that would include life insurance companies, particularly European life companies, and anybody who has written long contracts with minimum floor yields on them, which they now can't afford to pay. And it, of course, includes pension funds, who are, if you look around, pretty broke in many places, in Puerto Rico being a notable example, but for other reasons. But think about this mirror image of the savings and loan crisis, which has now, in my opinion, been greatly exacerbated by this very duration play that the central banks have done. Is that something we should worry about?
So let me just say, I mean, what you're saying is that pension funds and insurance companies, for example, made very bad portfolio choices, and
just like S&L did,
and put themselves at risks. And I think the point is, I think the point is well taken. Now, the question is, should the Fed have let the unemployment rate stay higher and inflation lower for longer, thinking that private sector portfolio managers would act irrationally? So that's where I think I would draw the line. But I think it's an interesting point.
Yes, Brad.
So, building on what Larry says, there are trade-offs. By holding short-term policy rates low and indirectly keeping long-term rates low, of course, and set aside the fact that if you believe Larry Summers' secular stagnation argument, this is just kind of a new fact of life. Returns are going to be lower, period. But by holding the policy rate low, the amount of financial distress in the Spanish mortgage market went way down. The amount of financial distress in the Irish mortgage market went way down. There were much fewer losses on legacy mortgage assets throughout Europe, and that had a positive effect. So I think you have to look at both sides of to use a French word, the bilan. Is that correct? The balance sheet?
Desmond, and then you want to comment. Olivier, we'll take those two comments, and then we're going to go to audience questions.
Alex, I think your point is well taken, but I think that you might want to extend it to the very many money managers who have invested in a lot of these long-term assets that once the party stops, they could be in trouble. So I think that the way in which our banking system or our financial system has changed is that there's a lot of duration risk out there with hedge funds or money managers who, once they get the withdrawals, this thing can really cascade.
Olivier?
So I think the issues are essential because these are this kind of collateral, not damage, but collateral effects of monetary policy. But we have to distinguish in low rates and whether they lead to more risk-taking or not. And I think Brad made a very important point, which is low rates decrease the leverage of debtors. And that's good. And that's one of the things we need to do. It creates other things which go the other way, but I think it's a mixed basket, bilan, if I may say. Then the QE part, which kind of changes, not distorts, changes spreads. And there, for example, people are talking about the adverse effect of negative interest rates on the profits of banks. QE has had much larger effects on the profit of banks, because in the old days, when bankers went golfing in the afternoon, the way they made money was basically by borrowing short and lending long and basically getting the term premium. Term premium is gone. That's a much bigger deal than the negative interest rates at 25 basis points. And that is, maybe we should still do it, and I think we should still do it, but it's complicating the life of the banks and by implication having effects on the economy. So you really have, this is why I really want one day to go back to the Fed moves upon the federal funds rate and we don't have to think about anything else. We'll make Larry's life easier, actually.
That will be the renewed orthodoxy.
Keeping a high balance sheet would actually help that, but okay.
All right, ladies and gentlemen, it's your turn. And I see a younger fellow back here I'm going to call on first. Let me remind you, though, of how questions work at AEI. Please wait for the microphone. Please tell us who you are and what your affiliation is. Ask your question. If you feel compelled to wish to compete with the panel in making statements, the chair will give you maximum 1 minute, and then I will have you come to your question. Bert.
Bert Ely, a banking and monetary policy consultant, and thank you for the comment about my age. A question for the panel. It comes back a lot to what Larry was talking about in terms of the QE squeezing out the term premium. And clearly, that is, someone used the term of sucking out the term premium. My question is this. Is this the new normal for the industrialized world? Is this a good policy for the long term? Or at some point in time, should we see the term, is it desirable for the term premium to come back, to return to the days, the decades of having a significantly positive sloping yield curve?
I think that's a question, first of all, for Larry, then we'll open it to the panel.
That is a very interesting question. The question here is, what is the steady state term premium today? It could well be zero. Okay, many people believe it's zero. And, before the crisis, I thought maybe 75 basis points. At one point, it was maybe 200 basis points. So the difference is, I grew up thinking the term premium was about inflation risk. Now, people in the markets look at bonds as a hedge against the stock market. In principle, the term premium could be negative. So we came down from 75 points to 30 basis points, but that's probably a little high relative to what market participants that I work with believe. So we could have a flat, I'm talking about funds rate to, I'm talking about this as the funds rate to the 10-year. That could be perfectly flat, or maybe more likely very gently upward sloping relative to what we have experienced in the past. That's part of the, call it the new normal, maybe not for all the reasons, maybe for other reasons. It's a different regime. What the regime will be 10 years from now, I have no idea, okay? But I start with the presumption that it's going to be like today in terms of the correlation between stocks and bonds.
If you're right about that, Larry, I will not be applying for any jobs as pension fund managers.
Either.
Other comments from the panel on that? Okay.
I think,
go ahead.
I mean, there's a lot of uncertainty as to what it's going to be, but one of them is what the Fed is going to do with respect to its portfolio of long bonds, and whether there are good arguments for the Fed to remain basically a holder of long bonds, or they should be in the private sector. I think there are some arguments for the Fed keeping some, but at the same time, I think when the Fed intervenes along the yield curve, it introduces uncertainty for investors, and that, maybe we get to a steady state where everybody understands the rules, but for a while it's going to complicate life. So I'd rather have the Fed get out of the long bond business, but that's my view, not a forecast as to what will happen.
Yes, here, please.
Tom Timberg, consultant. This is really for everybody. It was very good to hear that the large lendings to the emerging markets are counterbalanced by a large amount of capital flight from them. Though the question I would ask is, what is this likely to result in the case that the party comes to an end, and particularly in terms of our experience with the East Asian crisis, where we were apparently able, as for example the United States was with the UK during the Second World War, to snatch these private assets in the United States and use them to satisfy the creditors here. Now, I don't know, but
I love that question. Not entirely facetiously, I've said that the Asian financial crisis caused the stock market bubble. And what I mean by that, the staff came in and said, oh my God, we're slashing our forecast of net exports. We're taking the forecast down by 1.5 percentage points. And they were right and they were wrong. They were right about net exports, but completely wrong about GDP because domestic demand soared. And this is the two-sided coin here. Okay? Assets flowing into the U.S., into U.S. financial markets. What's the net balance there? And it's a interesting question. I think that question is often missed in terms of the nuances there and what the net effect might be.
Other comments, Desmond?
I think that when the capital flows into the United States, that might be a good thing for the United States in of itself. But what you also have to take into account is what sort of strains might that put on individual institutions, be they European or be they Japanese, that might have made loans to these kind of places. So I think that, for you to get a financial accident in this kind of environment, I would think the chances are pretty high, much the same way as, we saw during the Russian crisis, LTCM nearly brought the whole system down. The same sort of thing could happen here, because I guess my concern is you've had prices moving to the degree in which they've moved at a very rapid rate, that people who are on the wrong side of these bets, I think that could cause problems in the financial sector. And that's really where my concern is. My concern isn't that Brazil is slowing a little bit and that it means that U.S. exports are going to be slower. My concern is, what are the strains likely to be in the financial system, particularly when there's a whole lot else going on.
I think, again, it's another case in which the semantics strike me as dangerous. I mean, when we talk about these flows moving in, one has the impression of this wave of flows coming in and buying stocks and, lending to U.S. banks and so on. But remember, there's the relevant thing is if there's no reserve FX intervention, which in the US there is not, right, then there has to be, for a given current account, and it's not going to change overnight, there has to be gross flows the other way. And in equilibrium, net flows must be equal to zero or to whatever the current account balance was, right? So by construction, you have to have a flow in and a flow out. And so, part of this picture is basically what this reflects. That's accounting, right? So what this is going to do, obviously, is in order to basically make people be willing to go out, there's going to be an appreciation of the dollar. So that's unambiguous, and it's going to happen. It's probably going to decrease the flows relative to a situation in which the exchange rate would not have moved. But then the question is, what else does it do? And Larry's saying, well, it really did big things. And then what matters is the nature of the gross flows in and the nature of gross flows out. So if all the foreigners basically want to put their money in the stock market, the US stock market, and the guys who are convinced to get out put it in something else and we're not in the stock market, then stock prices are going to go up. If the foreigners want to put it in US banks, then and the guys who are taking their money out are didn't come from there, then there's going to be an effect on credit. But it's a much more subtle issue than just thinking about, there are all these gross flows. That just is not the way to think about things. And when you read the press, it's nearly always set in these terms, which strikes me as well.
I guess what I would be worried about is that you might have a Portuguese bank that had made loans in dollars to a Brazilian corporate that is now not able to repay this Portuguese bank. And you have a little financial crisis in Portugal, and then you've got other people who are exposed. We've seen this before. That's basically, a Lehman domino kind of effect. I don't think that you can discount it. That if you get a lot of corporate defaults, somebody made them the loans, and I don't know how strong their balance sheet is. I'm just told that Standard Bank's balance sheet, Standard Bank is, pretty much stressed, as is Deutsche Bank. But I'm sure that there are a whole lot of little banks that I've never heard of. who've made ridiculous loans in dollars to corporations that aren't going to pay them back. And I think that those financial strains one's really got to be concerned about.
But Desmond, we enjoyed it so much on the way up. As you pointed out, the reason these bubbles and these moves are so difficult to control is everyone is made so happy by the boom while it lasts. Now, this was an excellent question, and I think, Brad, you have a comment you want to make, and then we're going to move to the next question there.
So the first comment is that the analogy to the 90s strikes me as a little bit off because the U.S. was starting with ex-ante much lower interest rates. So in order to have a big boom from all the money coming in, you need to see rates fall and the economy respond to low rates, and that seems a less plausible outcome. And the other part in which I think the analogy may be a little bit off is that the Asian financial crisis came because a bunch of Asian economies are running current account deficits financed by short-term borrowing in foreign currency from the rest of the world. None of that is basically accurate in describing the current situation in China. China is running a current account surplus. That surplus was sustained, and the domestic lending was domestic savings in China's own currency, intermediated through the Chinese banking system. So the analogy to Asia doesn't apply to the most important economy in Asia, and we need the likely scenario is, in my mind, somewhat different.
Thank you. I had one other comment too, Olivier. You mentioned the foreign flows, but you didn't mention real estate. And one of the most important in my opinion, cycle-inducing elements in these is that these flows often go into real estate and push the prices of real estate up. Paul.
Yeah, Paul Kupiak, AEI. I want to come back to this kind of shocking agreement that capital controls may be the way to go. So for years, IMF pushed you couldn't have capital controls and be a full member, and we can see the sort of point here when the parties, you want to do it when the party's happening and keep the party from happening. But if the economics profession at one time embraced free trading in financial assets, capital controls really mean limits on trading of financial assets. Well, how sure are we that the profession's not going to come around and say limits on the trade of goods and services isn't a good thing? Let me give you an example. So instead of preventing capital inflows into, say, Peru, that get invested in copper mines and expand the copper mining production because you think copper is going through a bubble, why don't we just limit the trade of copper outside of Peru if I'm an official? Isn't that the same thing? And are we going down that dangerous route? Are we really okay with that as a profession? Are we really there yet? I'm a little concerned about that.
Who would like to take that one? Olivier?
And the slippery slope argument is always made and is always relevant. But it seems to me that, we've learned things about the world. I mean, think about macro Peru. Basically, we've also shifted from the notion that financial markets would largely self-regulate to the notion that probably macroprudential measures are useful. Capital controls are not, except for on legal grounds, quite different from macroprudential. I mean, if you prevent somebody from borrowing in FX, that's a macroprudential measure. If you prevent somebody who wanted to lend in FX to come in, that's a capital control. So the distinction is a bit arbitrary. But I think there has been a move, I think more or less unanimous by economists and by policymakers, to think that financial markets don't work perfectly. And, if I was shown that same thing happens in parts of the goods market, then yes, I would make the argument.
Alex?
Other comments, Desmond?
Maybe I should just mention to Paul something that I've mentioned to Alex on many occasions, that I was taught as a student some 40 years ago, that D.H. Robertson said that economic fashion was like going to the greyhound races. If you stood still long enough, the dogs would come around another time. So, I think we're seeing this again.
This was once more reflects the difference between optimism on my part and pessimism, because I see science advancing all the time, not going in circles.
I have a question over here, and then I'll get back to you, sir, and we're getting toward the end. Yes, excuse me. Here.
Thanks a lot. That was a lively discussion. I have two questions, one for Mr. My name is Abdul Al-Assad. I am a student of economics, so take it easy on me. I'm still learning. My first question is to Mr. Desmond. You said that the Federal Reserve was kicking the can forward in 2008 with QE. I'm curious, what would you have done differently? What else would you do at that point? What could be the perfect policy? And my second question is to the panelists. As a student, I am told that there are two policies that the government could use to fix the economy. The first is monetary one, and the second is a physical one. Monetary has proven to be effective to pull us out of a recession, but ineffective to boost the economy. Fiscal policy is ineffective for obvious political reasons. Why doesn't the government itself lend money instead of going through the banking channel? Today, the government can borrow on a 1-month treasury bills at 0.25 interest rate. Why doesn't the money borrow this money from the financial sector and let's it to the people directly? And then the government would be able to take the money back from the citizens, and if they default on their loans, that would be used as a fiscal stimulus.
Okay, thanks a lot. Those are two good questions. Let me just note on the second one, because I want Desmond to answer the first one, is like Desmond's dog race metaphor, this is a classic idea. Right now we have the government called Fannie Mae and Freddie Mac lending $5 trillion, for example, into the real estate market. But I'm going to let the panelists take that up. But Desmond, you had a direct question, do you?
I think, if one looks back, what one would have wanted is one would have wanted a more appropriate fiscal policy approach, that it seemed that the stimulus package was really very large, but it really wasn't very well designed. That what you should have had is you should have had a lot more that would have given you more bang for the buck, stuff that would have really got the economy spending. My point is that if the Federal Reserve, if too much reliance is placed on the Federal Reserve, then you're getting into a very second best kind of world. That if you're sitting at the Federal Reserve and they're not doing what needs to be done on the fiscal side, then perhaps you have little alternative. You're staring down the abyss. So you go through with quantitative easing. But the point I was just trying to make is that there's there's no free lunch. That creates problems later on. And I'm just suggesting that we're now living in the moment where we're paying the price for the benefit of all of that money printing at an earlier stage.
Other comments on what the Fed should have done compared to what they did do?
I'll take on the government lending question because
Hang on, we're going to come to that.
Oh.
Let me just get the first question done first. If anybody has other questions, no. Okay, go ahead.
So certainly one cannot accuse China of failing to use direct government lending, admittedly mobilized through the state banks. And the usual criticism of Brazil is that Brazil also rather overdid it on state banks and state-directed credit. I think the way the U.S., and the U.S. hasn't completely ignored this thought. The U.S. has a significant student loan portfolio. And I think there is a plausible argument that there's maybe a lot of risk there. There's also a plausible argument that the interest rate the U.S. charges to students perhaps should be lowered, and that's been a kind of common political campaign point. To Alex's point about the agencies, when I've looked back, and this kind of gets at the fiscal and monetary policy balance question, I think the U.S. withdrew fiscal stimulus too quickly. I certainly think Europe engaged in too much fiscal consolidation too rapidly. I think Japan has undercut its efforts to reflate its economy with premature and excessive fiscal consolidation over the past couple of years. In that world, the fact that the agencies were backed by the federal government and the Fed could buy agency mortgage-backed bonds without having to worry about credit risk, actually, I think, helped provide a measure of stimulus and an effective channel for supporting the economy because it allowed the consumer and household sector to refinance a lot of the existing mortgage stock at a much lower rate at a point in time when the U.S. government was otherwise doing fiscal consolidation, and the effects kind of helped offset each other. So I actually think it's a complex question.
It is indeed. And you were speaking of response after the collapse.
Correct.
Yeah. Other questions on letting the government make the loans? Okay. This is going to be our last question. I had a question way in the back there.
Hi, Victor Mizrahi. I'm not an economist, but it's obvious that the discussion has been very highbrow, sophisticated, intelligent, very good. That said, today, the likely nominee for the Republican Party is threatening to force companies like Carrier and Ford and Apple and others to manufacture all of their products in the United States. If he is successful, what does the Federal Reserve do then?
By the way, I'm not an economist either, and that's why we have these excellent economists
I
on the
wouldn't
panel.
even entertain that because politicians say a lot of stupid things.
They say many things they never do.
Oh, especially.
Any other comments on that?
A reasonable answer is that that would probably lead to a fairly substantial recession in the US if somebody was crazy enough to do it. And then the Fed would probably have to use the interest rate to try to limit the damage. But again, I think we will not get there. But I don't think the Fed can take a position on trade very explicitly. Right.
All right, I was wrong. We actually have time for one more question, and we can have this question here.
Thank you. My name is Li Yang. Thanks for your presentation, but I always think our monetary policy or fiscal policy usually is to benefit those financial institutions or those industrial complexes. They receive a bailout. For financial institution monetary policy, I just wonder if this is a real good capitalism, then there should be a fair market mechanism. So if the interest by the financial institution should be almost the same as those charged for consumers or homeowners or student loans. But now we have a big, huge gap. So I just wonder, unless there's benefit abuse of financial institution or those bailout, then they abuse their power or law enforcement, so they will not be benefit the financial consumers. So I just wonder if we can do something for the federal policy or FRS or any government regulation to really force a market mechanism work and the interest charge for financial institution or the consumer will be the same. Besides,
Okay,
if they
we have. I'm sorry.
Okay,
We've got the question. We're short on time. Monetary policy bailouts of financial institutions. Any comments how this? If Desmond is right, we're going to have a lot of bailouts in the emerging markets.
You have to make a big distinction between interventions at the time of financial crisis, panic, etc., and you can argue one way or another. I'm not going to get into that, and monetary policy. Now, monetary policy lowering rates is supposed to lower the unemployment rate. That, as the Fed would say, is good for Main Street. Is it good for Wall Street? I don't know. But it's sure good for Main Street, I can tell you that. And that's where the benefit comes from. And one could also make an argument that bailing out some firms and having all these incredible facilities was also incredibly good for Main Street in terms of what would have happened if the Fed and Treasury, et cetera, hadn't followed those policies, and there was instead of a Great Recession, there was another depression.
Okay, I want to give the panel, if anybody has a parting shot of a final thought, do you want to get out? Okay, thank you very much for an excellent discussion. And we appreciate the panel, and ladies and gentlemen, we appreciate your coming.
You are more bearish than I would have expected.
The IMF forecast.